but the installation, the organization, QE, the adoption of monetary theory, the dire straits where our companies are in because we're in a low growth environment, well, this creates a setting, this sets the scene where if the ones in power are willing to abuse this power, they could go all the way.
Welcome to the GoldRepublic Podcast. My name is Bart Brands.
And I'm Alexei Jordanov. In our weekly podcast, we invite guests from all over the world to get valuable insights
into the emergence of a new monetary system through the lens of precious metals, cryptocurrencies, and other financial instruments.
So what I feel is maybe a bit outside of the conversation, but we touched upon several elements in here, like to a bit resume the conversation we had so far. We went from the evolution of money as being the fuel of the engine of the monetary system and the financial world, basically bridging between economy and finance. And then we talked about basically a common element between the notion of trust. The notion of trust being kind of the core of all that, kind of the glue between all those grains of sand, if I may make towards the analogy. Those grains of sand today have less and less trust towards the bigger pile, meaning we see an increasing distrust of people versus institutions. We see a distrust in not only banks, but also governments, people that they get elected from. I see your head is nodding on every side. That distrust might also lead to social unrest or other things that might not be present or seen in the financial world because there might be also disconnect between those that maybe lose too much and those that win too much. How do you see that, and how do you think that this trust basically plays into an equation between all those elements interacting with each other?
It's a very dual situation because I can see, in fact, two groups of people. You have a growing crowd of people that no longer trust the current financial and economic system. And it's no coincidence that when we left the gold standard back in 1971, that you can see inflation going up, but also the real performance of gold going up significantly. Because when we left the gold standard, gold was at about $40 per troy ounce. Today it's 1,835. Last time I looked this afternoon. So with a tremendous rise in gold over the past 50 years, it's a reflection of a distrust in the current fiat monetary system. More recently, if you look at the rise of cryptocurrencies, Bitcoin was the first blockchain-based cryptocurrency, was launched at the end of the financial crisis of 2008. And also one of the reasons why it was created. Bitcoin, by the way, is willingly, you have both the blockchain technology, that is something innovative in itself, but you also have the whole concept of Bitcoin as being not a coincidence, but willingly to offer a digital alternative to physical gold. Bitcoin, if you leave the blockchain aspect aside, is a digital imitation of physical gold. And if you look at the rise of the value of Bitcoin from zero 12 years ago to about $600 billion today in market value, it is also a reflection of a growing distrust in the current monetary system and this continuous buildup of debt. At the same time, what you can also see, and that's another group of people out there, is that you can see that since the financial crisis, you can see bigger and bigger government being built, and the quantitative easing, central banks jumping in and buying up tremendous chunks of debt. If you imagine, just a few numbers, the European Central Bank, the ECB, through quantitative easing, has bought now more than 60% of the GDP of the Eurozone is on the balance sheet of the ECB. So if the Maastricht Treaty, to quote the Netherlands again, because this treaty, Maastricht Treaty puts a limit on indebtedness of 60% of GDP, Well, today the ECB, from that point of view, is breaching the Maastricht Treaty. So 60% of the Euroland GDP is now being held on the balance sheet of the ECB that have bought all these government bonds. At the same time, as we saw last year with COVID-19, now there's another group of people that's starting to look at the government as that the government or big government should be out there to save us from everything. And so it's a very dual world, I think. You have a growing group of people that don't trust the system anymore, and they are buying gold and cryptocurrencies. There's also a group of people that now are looking at big government as being the savior out of this mess. And so I think it's a very dual situation. I can see that there's a tighter and tighter grip of government and especially supernatural institutions on daily life. You have the World Economic Forum today. If you look at some of the ideas that are being formulated there, there's this famous quote about 2030 of one of these Danish members of parliament that is part of the glossary of the World Economic Forum. Their vision of the future, her vision of the future is that in 2030, well, today the tagline has become, I own nothing, and life has never been better. But the original quote said, I own nothing, I have no privacy, and life has never been better. Now, if you I'm not saying it's going to happen, but it's an interesting thing, because I'm going to connect with your question about Bart, about modern monetary theory. Now, if you look at this world, where more and more that the government and supranational institutions are driving the whole economy. In Belgium today, public expenditure is equal to 60% of GDP, 60% of GDP. In America, it's about 45%. You should know, before the Second World War, the average government spending was about 7% of GDP. Today, we're up at 60 in Belgium, 40, 45 in the United States. So big government is growing and growing and growing and growing. We have in the European Union more and more claiming power, and the IMF today. So we're moving towards a world where you have a much more centralist steering of the economy. Now, if you take it to the extreme, as some of these ideas that are circulating in the circles of the World Economic Forum are doing, and you take it one step further, in fact, they are talking about abolishing all private property. Now, I'm just referring to Karl Marx. Karl Marx once said, or once wrote, that the essence of communism is the absence of private property. Now, I'm not saying we're going towards, we will have a communist system, but we're halfway there. The question I would ask to the audience, if you are able as a government, with the help of central banks, to drive interest rates below zero. Now, if I would be able to borrow money and get money in return for it, I would buy everything I could buy my hands upon. And just for as an anecdote, I bought a piece of land recently, totally with debt, because now I can borrow for the next 20 years at 1%. So I think it's a great deal. And if I would be able to borrow money at below 0%, I would be buying even more land. Because that's the situation to create if you have bond yields way below inflation. Well, you should, in fact, from a financial perspective, be borrowing everything that you can. And now, as long as the government, I'm not saying that they will be able to sustain these low interest rates forever, because at some point the trust will disappear. But if there's a new crisis hitting us, we'll again turn to the central banks that could expand quantitative easing, not only buying bonds, but buying any private asset. It's already happening in Japan, because Japan is 20 years ahead of Europe, but the Bank of Japan has not only bought a tremendous sum of government bonds, they've always also been buying ETFs, investing in Japanese equities. And the ECB and the Federal Reserve have already said that if need may be, they will expand QE. They also could expand QE to buying gold. What happened back in the 1930s with the confiscation of gold by Roosevelt. And so it is not unimaginable that the central banks expand their mandate and start buying more and more private assets. What happened back in the financial crisis in 2008 is that certain big companies like GM and Ford were into trouble. And so, in fact, they were bought and rescued, like the banks in Europe, by the government. And so if you have a system with quantitative easing in the middle, driving down and pushing down bond yields, enabling governments and central banks to buy anything they like, any private asset that they like to have, you could create a situation in which, during the next financial crisis, all these private companies that run into trouble are going to turn towards the government and say, please bail us out. The central banks buy bonds being issued by these corporations, being bought by the central banks. Governments can take on more debt thanks to issuing more debt to buy private equity. And then now go back to where Bart was starting off, another side of modern monetary theory, that you don't only see an issue with having more and more debt, they also don't have an issue with the consolidation of the balance sheet of the government with the balance sheet of the central bank. And so just thinking out loud, how could you go to a situation of the government owning everything? Well, just wait for the next crisis to hit. Use the central bank to keep bond yields extremely low. Use these low bond yields to buy up all private assets that are distressed. And then you apply modern monetary theory. You consolidate the balance sheet of the central bank with that of the government. And there you have it. Then you have the government controls everything. I'm not saying this what I'm dreaming of. It's more like a nightmare. But the mechanics to go there are in fact now in place. Where if the ones in power are willing to abuse this power, they could go all the way.
The follow-up question then, of course, would be, would that be sustainable? Because you see that most governments are extremely inefficient. Bureaucracies are, but it will probably take a lot of time and cause even more suffering if it is tried.
I doubt that we will ever get there, because I think we'll have a revolution before we get there. It's also something that modern monetary theory doesn't seem to understand, that again, it's the psychology of people. We have now riots in the streets of Netherlands. I'm not saying that this is the kind of riot I'm talking about, but at some point, if we stretch it too far, some people are going to say, well, I don't accept it anymore. And then you get a revolution. Also, what you were saying, Alexei, is that very often in the past, we have seen that social unrest very often was initiated by inflation. Yeah, because when the price of food goes up, then people start to feel it in their everyday life that they are into trouble. You should know that in the 19th century, 40% of the total financial budget of an average family was destined to buy bread, not food, bread alone. So you can imagine when inflation, when the monetary system went into trouble and inflation followed, this had a significant impact on the well-being of the people. And then we got these upheavals and it's all these social unrest, just like the French Revolution. We had major riots because inflation was going through the roof. And so when food becomes very expensive, then people start rioting in the streets. And the other reason is, as you're seeing today, when people, I'm not making a judgment call, I'm not condemning, I'm not saying that the riots, just saying when people feel that their liberties are taken away, they might also riot. Or the people rioting, I'm not saying that they should be rioting or anything. They are obviously rioting because they feel that their liberties are being restricted too much. Well, this is not theory. If you read some of the papers of Christine Lagarde, the former head of the IMF and today of the ECB, today, if you talk about cryptocurrencies, that only the private sector work on cryptocurrency, because Bitcoin, but you also have the CBDCs, or the Central Bank Digital Currencies. And then it becomes quite scary, because you can imagine a scenario in which the global economy moves to a new monetary system in which the only currency or money becomes a central bank digital currency. Now, crypto money or cryptocurrency, thanks to the blockchain, is smart money. Today, the money we have is dumb money. €1 is €1, $1 is $1. Money on the blockchain is programmable money. We could have a new monetary system using the special drawing rights of the IMF, what have you, but one central bank digital currency where all of the money that you hold will in fact be your account, Alexei, and your account, Bart, and mine account, will in fact be an account held at the global central bank. And so every money that you spend, everything you do can be monitored by some central authority. And it could be the case already, some ideas now floating around in the monetary space, that if you're spending too much money on alcohol, if you go to Albert Heijn and you buy booze every week, well, it can be that your credit score is going to go down significantly, that you'll no longer be eligible to have a job. We can also program money to say, well, Bart is a very wealthy person. He doesn't need to earn interest on his money. And so the CBDCs being held in the account of Bart can be programmed to have a negative interest rate, while some poor student with a student loan will say he doesn't have enough money, so we'll get a positive interest rate on his CBDC. So all of these things are floating around in this great reset idea. I'm not saying that we will go there. I'm just saying that we should be paying attention.
Well, of course, we can already see this implemented in China with social credits scores.
That's a communist society. That's a totalitarian regime. Yeah. And so essential, the crypto yuan, and there's also talk about in my latest book. It is not a coincidence that China is one of the first countries to move towards a central bank digital currency, because they will like to have more control of the whole Chinese population, not only by cameras, but also by having an eye and having information about everything that the Chinese people spend on anything. So, this fits really well with totalitarian regimes like the Chinese one is.
I think it's spot on, and it gives me goosebumps now in the wrong direction. It is, in a way, the combination, when you think about it, when data also becomes currency, when we talk about social media companies farming that data that we produce for selling it to advertisers and maybe in the future to other interested parties, which we don't know how it evolves. And then on top of that, peg it to the control of value and money into our bank accounts, we have a system which is closed from every kind of side, and it ties us to pretty much anything we do, interact, or basically produce in one or another. What is this is the grim side of things, but I'm also like to see the light at the end of the tunnel, and I would like to hear from you. What are the possible systems that we could see on the bright side of things that could work on a global scale without going into dictatorship, global corporatism, or all kinds of other versions of dictatorships?
Well, in my ideal world, I think the best system would be a system in which you have a whole ecosystem of different types of money that coexist. I think there's no issue in having private money systems like Bitcoin is next to fiat money systems. I think the two can go along, can coexist as you're doing today. It doesn't have to be either one of them. If you look at the fintech world, the financial technologies, all the developments, they have made one huge mistake in the past, that they've tried to build their financial innovations by linking them to the legacy IT infrastructure of the existing banking system. I think that the route that you now take in the fintech system by developing an alternative system being built on the blockchain is very, very exciting because it is smart money. You can program up the money. It is something much more efficient. If I make a payment across the borders, a cross-border payment within the European Union, the current banking system is totally inefficient. Well, it's very inefficient because there is a difference between the instruction and the actual settlement of my instruction. SWIFT is a societal worldwide interbank financial transactions. It's not a payment system. It will just transfer payment instructions to other banks, other countries. Now with crypto, the instruction is the same thing as a settlement. It's much faster, so much more efficient. And so I think there are great things going on. Will be great innovations on the fintech side. And so I'm hopeful that we will go towards a more diverse financial ecosystem.
Yes, what I would like to add to this, I think the key here is maybe the concept of interoperability, right? The fact that in DeFi, so decentralized finance, what Ethereum is basically the engine and the platform of programmable money is about building those bridges, not only about Ethereum and Bitcoin and Ethereum and other cryptocurrencies like the 8,000 other cryptocurrencies, but within basically the current financial system or the notion of value, the value economy. There's also basically a concept which maybe we didn't touch upon, but it might be relevant, is that the one of Keynes, the fact that he proposed the notion of banker, the basket of a couple of currencies. There was the same thing of the Amsterdam Civil Bank that also backed basically the Gildaar thing, if I'm not mistaken, with gold, silver, and other assets to basically still remain that stable value. What is the potential of those kind of thinking for that more decentralized and monetary system that we could see emerge in the coming years and decades?
Yeah, well, you can see that the old idea of the banker, which was coined by Keynes during the Bretton Woods conference back in the 1940s. Well, he was English, he was British, so the Americans, in fact, got their way with the dollar standard or the dollar gold standard. But back in 1967, I think, or 69, the IMF, which was created during the Bretton Woods conference back in the 1940s, then launched the special drawing rights with some different way of the banker. We have a basket of commodities and currencies backing the SDRs. And so today, there are voices also in the international community that we should move from a global dollar system towards a system where we have the SDRs.
For listeners, which stands for SDR?
Special drawing rights are created by the IMF, and every country that is a member of the IMF gets an allocation of a certain number of special drawing rights. Yeah. Now, these special drawing rights, they cannot be used to go to McDonald's, but countries can convert these SDRs in a basket of real currencies like yen and dollars and British pounds, what have you. And so by doing so, they can swap the SDRs for a basket of currencies, or they can swap currencies for a basket of SDRs. It's like an international means of payment among countries. Now, this becomes really technical. I'm not sure we can go to great lengths about this, but today you can see the world is still very much on a dollar standard because most of international trade, I think it's 65 to 70% is being settled in dollars. And so today, especially China and Russia and other countries like Turkey, they are fed up with the Americans. The Americans are abusing their monetary, their place in the monetary system to impose their sanctions upon other countries. And so there are more and more people or countries willing to move towards a new monetary system. China is the primary, the obvious candidate to plead for such a new system. But given the fact that China is a closed totalitarian regime For them, the idea that they would replace the dollar by the yuan as the global reserve or trade currency is unthinkable, because it would imply that they would need to open up their own domestic capital market, which goes against everything that the Chinese Communist Party would like to see. And so for them, a frontal attack of the yuan or the crypto yuan on the dollar is not on the agenda of China, because it is not something that it is a fight they cannot win, because they don't have the openness of the financial market that's required to be able to be accepted as the global reserve or trade currency. And therefore, it is the Chinese that want to dilute the actual power of the dollar by moving towards a reset of the global monetary system, by using a new version of the banker or of the SDRs, by using a basket currency. And so the SDR being backed by a basket of currencies, already the weight of the yuan in this basket has been increased to reflect the higher weight in the global economy of China. If you look at it from the angle of the emerging markets, among them China and Russia and Turkey, they would, if they can choose today, they would move instantly towards a new international monetary system with some kind of basket currency, SDR, so whatever you're the banker, as the new monetary system. And even the Americans may be willing to go along this route, because having the global reserve currency and trade currency gives certain advantages to the United States, but also certain setbacks. There's the Triffin dilemma, if we go to macroeconomics, is that the country with the global reserve currency is in fact almost always condemned to continuously run a very large trade deficit, because there's so much demand for its currency. And so there could also be a win for the United States to go along with a scenario in which the dollar would still be a big part of the basket of the international currency, but to a lower extent than is the case today. So this could be a possible future also, where you have the SDRs, the banker, as a new global currency or a basket of currencies.
So how would you then manage your money accordingly in the wake of such an event?
In the long run, you cannot beat diversification. And so what I've been trying to do over the past 30 years, both for my customers and myself, is to build the ultimate diversified portfolio. Because the future is very uncertain, and even though we don't like the idea, much of what is going to happen to the future will remain unknown. I would refer to Pericles. Pericles was a great ruler of the ancient times, and he once said that governing or good governance is not about predicting the future, but by preparing for the future. And so if you want to prepare for the future as an investor, you should really try to hold the most diverse or the best diversified portfolio possible. That's what I'm trying to do. And I'm always trying to improve diversification in my portfolio. If there are new asset classes emerging, like cryptocurrencies, you should always take a keen look and say, well, does this, yes or no, add to the diversity of my portfolio? So diversification is the only and the ultimate response to a world of uncertainty and to a world in which you can expect, all other things being equal, that we're going towards a new major financial and economic crisis.
On that note, to make it practical for listeners and viewers, how do you approach this? So what is, let's say, your modus operandi, or and then that's one question. And then the second question would be, what assets as a macro investor, so when you look at the big picture, do you long?
First rule is to have a mix of financial and of real assets. I'm not only talking about gold, but I'm also talking about real estate, for instance. And so have a significant part of my own private wealth in real estate. I will invest in gold. It's also a real asset, Because if you get into a major crisis, economic financial crisis, well, your best store of value will probably be real assets, because people will flee the financial system. They will sell off their financial assets to buy real assets. This also happened if you take the most extreme example, not saying we're going back to hyperinflation because it's very, very exceptional, but if you go back to the post-First World War Germany, with the first real German democracy, the Weimar Republic, well, they went through a tremendous hyperinflation that they willingly created themselves because it was the only way to get out of their debt, of the war debt that was inflicted upon them by the other countries. And so in those days, if you held real estate or gold, you did really well. The people that were not holding any gold or real estate, they were the ones in trouble. And so if I'm not going to say it, hits the fan, you want to have real assets in your portfolio. Be it gold and real estate would be my two favorite real assets. But at the same time, certain real assets do not always have the best returns in the long run. You will see that gold, for instance, well, it's this classic anecdote that the salary of a Roman centurion, it's like an officer in the Roman army 2,000 years ago, when paying in gold, is about the same as the salary of a lieutenant of an officer in the Dutch or in US army today. Gold will hold its real value. Real estate, also very interesting, I think. There's some Dutch data also in the book. If you look at the evolution of real housing prices, I'm not talking about commercial real estate that you're renting, but about your own house. Well, if you look at the price evolution of private properties, of residential real estate and gold over the past 250 years, it's about the same thing. Many people think that their own house is their best investment. I think it's a good investment. You should have your own house or your own apartment, but don't expect that you will have very high real returns from investing in gold or in your house. It's something that will keep its real value in the long run, but you also need to invest in financial assets if you want to really build substantial real wealth above and atop of inflation. That's why you need to have a mix of both real assets that will keep their value, that will act as a defensive asset when it goes really bad, when you have a depression or recession, but to be able to build wealth, you should invest also in financial assets. So the first rule is to have the right combination, to strike the right combination between having real assets in your portfolio and having financial assets.
You just described it. I think depends also the type of investor you are in. If you're more, let's say,
Sure.
risk-taking or less risk-taking, is there maybe a certain model or a benchmark on the percentage or allocation between those two types of financial versus real assets of the way of basically approaching it?
If you are unable to sleep at night because the stock market has dropped by 5% or 10% in one day, well, perhaps it's a better idea that you don't invest too much into the equity market. But it's a very tricky question, because if you follow your animal instinct, people are too risk averse. It's a phenomenon that's been described over and over again in academia by behavioral finance. People tend to weigh losses 2.5 times more than they weigh gains. So to lose €1 creates pain that's 2.5 times as big as the pleasure that you get from winning €1. So if you only follow your animal spirit, and Mother Nature has made us to be quite risk averse, because you know for a very long time you have been living in a very hostile and very dangerous environment. I think a good combination that you have half your portfolio, not original, but half of your portfolio into real assets, including your own house, and the other half on financial assets.
And does that also mean, because you talked quite a bit about, for example, some of the cryptocurrencies, are you also allocated in cryptocurrencies?
Well, I'm not going to answer that question. I was relatively skeptical when I was writing the book last year. Let's say I'm becoming less skeptical today, because the past couple of months there's been a change. Since the book was written, was done by the end of September of last year, I was not able to integrate this, but today, over the past couple of months, there have been a number of evolutions regarding crypto. Again, I go back to the point I was trying to make earlier on. Money or store of value is what people want it to be. Gold today, the global stock of gold that we have today is 200,000 tons. That's all the gold we managed to pull out of the ground over the past 6,000 years. Now, this all fits into a cube of 22 meters high or 4 Olympic swimming pools. But nonetheless, the total market value is $12 trillion, or 10 trillion euros, or 10,000 billion euros. Now, gold is a scarce commodity, but scarcity cannot only justify that kind of money. The global stock market is $100 trillion. So gold is about 12% of the global stock market. And so this reflects what I was saying, is that when there are sufficient people that want to believe that gold, these 200,000 tons, are worth $12 trillion, they will be worth $12 trillion. But it all depends on the number of people willing to accept gold as a store of value. Same thing applies to cryptocurrencies. I think until September of last year, the mainstream attitude of the big players in the market was a negative attitude against crypto. I could quote Larry Fink, so the CEO of BlackRock, the biggest asset manager in the world, who back in 2017 said that, well, crypto is money for criminals, something like that. Now, in December of last year, so that's not long ago, he has now changed his opinion and has called the Bitcoin a potential new global asset class. I think last week, they are now opening up some of their funds to permit them to invest in crypto. You can see Fidelity has applied for permission to launch a crypto funds. We had PayPal accepting a Bitcoin and what have you. And so this is a very recent evolution. And it's telling me that there's a growing wider acceptance of crypto as a acceptable investment, that you can also invest in certain institutional circles. Some private banks, like some private banks in America and Switzerland, are now also offering crypto solutions to their customers. And so it's not about my opinion about Bitcoin or what have you. It's about tracking where the general opinion is heading to. And today you can say that compared to 4 or 5 months ago, the acceptance of Bitcoin in certain institutional circles has grown. I'm not saying it's grown everywhere, because there's also in certain government circles, you have the opposite evolution. If you look at what happened in the UK recently with prohibiting banks to settle trades in cryptocurrencies, what have you, it's not that you're already all the way towards global acceptance of crypto. There are some certain evolutions that make investing in cryptocurrencies more acceptable today than it was a couple of months ago.
You wouldn't rule out investing in cryptocurrencies yourself?
A smart strategy could be the following. In Belgium, it is illegal to promote cryptocurrencies. I'm not going to do it today. So big disclaimer, I'm not saying that I'm doing this for myself. I'm saying it's a potential strategy, and all the listeners should today make up their own minds. I'm not recommending anything. We're saying that a strategy could be the following. Now we have physical gold, $12 trillion. Okay, that's the total market value. You have Bitcoin, which itself is 75%, I think, of the total market value of all cryptocurrencies in the world. I think Ethereum is the second and what have you, but then it drops off very rapidly. Now, Bitcoin, as I was saying earlier on, is willingly a digital imitation of physical gold. Now, several things can happen. If you take one scenario, some people, very strong believers on both sides, will say, well, Bitcoin will go to zero because it's all a big Ponzi scheme. And if people lose confidence, Bitcoin could go to zero. In that case, you're best off by holding gold, physical gold, okay, as a protection to stay outside of the financial system. Now, the other case is that people say, well, in fact, Bitcoin is much better than physical gold because it is limited in absolute terms to 21 million. Well, gold is scarce, but it's not that scarce because in the middle of the earth, there's sufficient gold to put a layer of 4 meters thick around the globe. So the gold we can get to today is scarce, but the amount of money we have in the earth is just humongous. So you could say that from certain points of view, Bitcoin is superior to physical gold. And so the other extreme scenario is that Bitcoin replaces physical gold as the world's favorite store of value outside the financial system. This would mean that physical gold would go to zero because gold has no real industrial needs. The world can do without gold, and that the value of Bitcoin goes to 12 trillion. So those are two potential futures that are very extreme. But if you look at it from another perspective, say, well, we don't know what's going to happen. Another scenario is that the two coexist, that digital money, cryptocurrencies, is an alternative next to gold. If you make a choice for one extreme choice, okay, I'm going for physical gold, or someone else says, no, I'm going all in on cryptocurrencies. In fact, given that the future is uncertain, it's a very dangerous choice. It could be the right choice, but it is one chance out of two. What you could say as a potential strategy, say, well, I'm going to invest in physical gold, but as the two in total market value could converge to some extent in the future, today 12 trillion against 600 billion, it's even lower because about 4 million Bitcoins have been lost forever. So it's more like 450 billion. So it's a ratio of 25-1. Now we will see, it's not unthinkable that we go to a ratio of 5-1. Now in that case, it could be a wise choice that you invest both in physical gold and some minor parts of your portfolio in crypto, because then in case that the ratio becomes closer, you will do reasonably well. So I'm warning people that they should do their own homework. And please, if you're quoting me, quote this also. I'm just trying to, if you're investing is about assessing probabilities. And I'm just drawing potential futures and then trying to explain what could be a choice in which you minimize the risk of losing everything and somewhere maximize the best potential outcome, the best of both worlds.
If you could summarize this 2 hours in one tweet, what would it be?
Understanding or being able to define money is of extreme importance to any investor.
Spot on. Yes. That fits right in. I love it. I'll retweet it straight away. So for the listeners who are Dutch speaking and who would like to read the book, you can actually find this book, Heavy Metal, on bol.com. Thank you, Jan. And I think that like gold, which is internal, knowledge is as well. And you provided us with some really precious golden nuggets here.
Oh, you're welcome.
Thank you. Thank you very much for joining us on this Gold Republic podcast. For the viewers, if you have any questions, comment down below. If you're watching this on the YouTube channel, please feel free to like, subscribe, and see you in the next Gold Republic podcast.